Hello and welcome. My name is Melissa Galasso, and today we're going to talk about a new ASU issued by the FASB, ASU 2021-07. This ASU has been worked on for quite some time by the Private Company Council, and so we're going to take a look at what the impact is for private companies. So ASU 2021-07 really is impacting those entities who have what we call equity classified share-based awards. And as it mentions, this is a consensus of the Private Company Council. So the PCC looks to find alternatives as well as ways to make it easier for private companies to handle GAAP. And obviously, when you're looking at something like stock comp can be a pretty complicated area, but it's made more difficult by the fact that private entities don't have necessarily an active market for their shares. And so determining fair value can be very difficult. And so this ASU is really looking at how can we provide private companies with an alternative. So as I mentioned, when you're looking at the fair value of private company stock options at grant date or even upon modification to award, it's very expensive. Typically when you have to come to fair value, you need to use some type of fair value technique such as an option pricing model. And one of the inputs in the option pricing model is going to be the fair value of the equity shares underlying the stock option. This is usually called the current price input. So this standard, again, because it's the Private Company Council, only impacts non-public entities, and again, only those that issue equity-based, share-based payments, or awards. Not everybody does, but for those who do, this can be very cumbersome. And so they've issued a practical expedient. That practical expedient is designed to help make it a little bit easier for entities to figure out what is their quote-unquote fair value. And basically the new standard here allows them to determine the current price input of these equity classified share-based awards that are issued to employees and non-employees. Again, so it doesn't have to necessarily be employee share-based payment. It could be non-employee share-based payment using what they call the reasonable application of a reasonable valuation method. So what do you have to do for things to be quote-unquote reasonable? So factors that you would consider under a reasonable valuation method include the value of tangible and intangible assets of the entity, the present value of anticipated cash flows, the market value of the stock or equity interest in similar corporations or other entities who do engage in trades or businesses substantially similar to those that the non-public entity is being valued, recent arm's length transactions involving sale or transfer of stock, and then other factors such as control premiums or discounts, and then again, using a consistent method of valuation. So they do provide some things, some guidance on what is not considered to be reasonable. So the use of a valuation method that is not reasonable, if that method does not take into consideration when applying its methodology all information available that's material to the value of the non-public entity. And so the standard is really trying to get at a backdoor. And so this is something that they really debated back and forth for some time. It's been something that they've been talking about for a while now. And they wanted to use the Section 409A of the Internal Revenue Code, right? So the IRS ruling. But they didn't want to explicitly do that because if the IRS changes their rules or if you're making reference to other standards within a standard, that can be very difficult in application. But for most entities, they have to, for IRS purposes, do a 409A. And so what the PCC was trying to do was get 409A to be an acceptable methodology. And so they did it through this practical expedient. And so these characteristics are used in a 409A evaluation that's under the U.S., again, Internal Revenue Code for the IRS, which is the U.S. Department of Treasury, to describe a reasonable application of a reasonable valuation method. So the outcome, a reasonable valuation performed in accordance with the Treasury regulations, would be an example of a way to achieve the practical expedient. So it's not saying this is the only way, it's saying it's a way to get to this practical expedient. And so I think this was a well thought out, well done process over the time. They've kind of really took a lot of feedback in. They wanted to use the 409A. They knew there would be implications of the 409A not necessarily always being there or being changed, and then would they really still want GAAP to refer to that? So when we look at this, they really went with a more holistic approach and then basically listed 409A as an example. So in terms of application, this can be applied to all share-based payment awards within the scope of the practical expedient that have the same underlying share and the same measurement date. And so in terms of effective date, this is a prospective application for all qualifying awards granted or modified during fiscal years beginning after December 15, 2021, as well as interim periods within those fiscal years. And it does permit early adoption. So you can even adopt it early in an interim period, so long as the financial statements have not yet been issued or made available for issuance as of October 25th, which was the date this standard was issued. So I know that's a very niche area. Stock options is not something that all private companies get involved in, but for those who do, the cost and complexity of having to come up with a fair value for those shares has been really, very difficult. And so this standard was really intended to try to make it a little bit better. So I want to thank you guys so much for joining me today on this nano learning, and I hope to see you on a future learning. Have a great day, guys. Bye-bye.